You may have heard of the word dividends before. Maybe you even receive dividends from your investments. But do you know why you would or wouldn't want to receive dividends? Also, on that note, if you do receive dividends, should you be reinvesting them? How would you go about reinvesting them? And is there a way to do it automatically? We're gonna be answering all of those questions in this video, and I think that we should just jump right into it. Let's go. So let's start from the beginning and talk about what dividends are. When you purchase a stock, you're literally buying a tiny piece of ownership into the company whose stock you're purchasing. So stocks are a little piece of ownership in a company. Now you can buy stocks directly by buying shares of a company that you're specifically choosing, or you can buy stocks indirectly by buying shares of a fund like an ETF that has different stocks inside of it. Now a fund is like a basket that's full of different types of investments all bundled up and put together for you. And an ETF or an exchange traded fund is just one type of fund. Now, a fund could be diversified in many different ways, but to keep things simple and also aligned to the topic that we're covering today, think of an ETF as a basket full of multiple different stocks. So to sum that up, you could purchase one stock or multiple stocks yourself, or you could purchase a fund that has multiple different stocks inside of it. Now, sometimes when a company has the money, they might decide to pay out dividends to reward investors who own a piece of them, and these investors are called shareholders. So dividends are payments that you receive on a consistent basis. Now, that's typically every quarter, but it could be every month, year, or at the company's discretion in exchange for you owning a piece of a company. Now, dividend payments are usually a percentage of the company's earnings that they're paying out to you. You can kind of think of it as profit sharing, right? So when the company makes money, they're paying out some of those profits to their shareholders. The dividend payment will be a set amount of money per share that you own. So for example, let's say that you own 100 shares and the dividend payment is $1 per share per quarter. That means that you would get $100 a quarter or $100 every 3 months. Sometimes the stocks from a company that pays dividends are called dividend stocks, which basically just means that this company pays dividends if you own their stock. Now, the dividend payment amount is called the dividend yield. Dividend yield is how much a company pays out in dividends each year relative to its stock price. In other words, it's showing you how much the dividend is as a percentage of its current share price. Let's use an example to explain this. So let's say that the amount that a company pays out in dividends is $5 per share annually, and the current price of one share of this company's stock is $200 a share. That would mean the dividend yield is 2.5%. Now, the reason that looking at the dividend yield, so that percentage, is better than looking at the dividend amount, so the actual dollar amount, is because looking at the percentage lets you compare two different stocks' dividend payments more accurately. Now, let's talk about what the dividend yield means for you. So if the dividend yield for a stock was 2.5% and you bought $100 worth of that stock and you held onto it for a year, assuming that it's an annual dividend payment, then you would get paid $2.50 in a dividend payment at the end of the year. So you can basically think of the dividend yield as like the interest rate on a savings account. Now, the dividend yield is usually pretty consistent. It might fluctuate slightly, and of course the percentage is going to shift slightly too pretty much every time a dividend is paid out because the price of the share is always going to be going up or down a little bit as well. But unless the company experiences some sort of major change that makes them significantly increase or decrease the dividend yield, it should remain pretty consistent over time.
If you're wondering why a company would pay out dividends, it's basically an incentive to get investors to purchase their stock. The company either wants new investors to purchase their stocks for the first time, or they want their current shareholders to continue to invest. Some investors like the idea of receiving additional income through dividends, and in general, companies that pay out dividends are seen as solid, strong companies that are doing well. Both of those reasons are why companies might want to pay out dividends, so that investors are more likely to buy their stock. If you're wondering why dividend-paying companies are seen as strong investments, think about it like this. If a company can pay out dividends, that means that they have cash and can afford to pay out dividends. In general, dividend-paying companies are typically well-established, stable, have the cash available to pay out dividends, and generally have less room for growth. These companies have usually experienced a lot of growth in the past, and it's evened out. Maybe they're still growing slowly now instead, but are still profitable and have the money to pay out. Overall, these companies are usually doing well financially and project that they'll continue to make money in the future too. On the other hand, growth-focused companies are kind of the opposite. These are companies that are in their peak growing phase and likely aren't paying out dividends because they're reinvesting the money back into the company to help it continue to grow instead. Sometimes these companies might also be doing well, but they want to put their money towards more growth. Sometimes growth-focused companies turn into dividend-paying companies in the future. In general, companies have a decision to make, right? Are we going to take our profits and pay out dividends, or are we going to take our profits and reinvest them back into the company for growth? or a mix of both. Now, we want to make it clear that this doesn't mean that companies that don't pay out dividends aren't doing well. Like we said before, sometimes companies don't want to pay out dividends because they need that money to reinvest back into the business so that they can continue growing it. Or they might have different other business needs to actually continue to help that business run. In general, companies that pay out dividends are more likely to be well established, and although they may be growing, they aren't growing like crazy anymore. Instead, they're steady, reliable companies that can afford to pay out dividends. On the other hand, companies that don't pay dividends are more likely to be growing still, and although they might be profitable and stable in the future, they're more focused on expanding and growing before that point. Something else that's important to keep in mind is that dividends aren't guaranteed. A company can stop paying dividends at any time. They'd likely only do this if there was a major change in the company's finances, because by getting rid of dividend payments or even reducing the dividend payment by a large amount, they'd likely be worrying investors. Think about it. Why can't they make this payment anymore? Which would most likely cause investors to sell their stocks, and then the stock price would drop, and that wouldn't be good for the company. We actually saw this with Algonquin Power earlier this year. So Algonquin Power is a Canadian company that's been struggling over the past few years, and they decided to cut their dividend payment by 40%. When they did that, the stock price dropped even more than it already had, meaning that investors have started to sell their shares after hearing the news.
Now we know why companies pay dividends, but why do investors purchase dividend-paying stocks? There's a few different reasons. Like Dennis mentioned, some investors see companies that offer dividend payments as strong investment options. They see dividends as a sign that a company is doing well, so hopefully that means it's a safe investment and they won't actually lose any money by purchasing shares of that company. Another reason is that some investors want to use dividend payments as additional income. Now, depending on the overall size of your investment portfolio, you could get to the point where you're earning thousands of dollars in dividend payments every month, quarter, or year, and you could use that money to fund your daily life and expenses. The benefit here is that a dividend payment is real money that you can spend. When you look at your stock market investment portfolio and you see all the growth that your investments have had, that's great, of course, but you can't actually do anything with that growth until you actually sell some of your investments and withdraw the cash. But with dividend payments, you wouldn't actually have to sell anything in order to withdraw the cash. On top of that, dividend payments tend to grow and increase in value more than inflation does. Now, this example really relates more to owning dividend-paying stocks inside of a fund like an ETF as opposed to directly. Let's use an example to explain this. So if we look at all of the dividend-paying stocks inside of an S&P 500 ETF, the combination of all of those dividends being paid out was $1.98 per share in 1960. Now, by the time we got to 2020, so 60 years later, that dividend payment was up to $56.70 per share instead, which means its compound growth rate was 5.8%. Now, let's compare that to the compound growth rate of inflation over the same period of time. So in 1960, the CPI, which is basically what's used to measure the cost of living, it was at 30, to 2020, 60 years later, when it was at 267. So inflation had a 3.65% compound growth rate, which means that the growth of dividend payments from the same ETF outpaced inflation. Now, another reason is that some investors want to use dividend payments to reinvest back into their investments. When you purchase a dividend-paying stock or ETF, you don't actually have to withdraw the money that you receive as a dividend payment. Instead, you can keep that money inside of the investment account and use it to repurchase the same investments or other investments. Here's an example to show you how that would work. So let's say that you purchase a dividend-paying stock inside of your investment account. So in your investment account, you have money that turns into shares of this dividend-paying stock. A few months later, after you receive your first dividend payment, in your investment account, you'll have money and the same number of shares of the dividend-paying stock. You would then use the money that's sitting there to purchase more shares, either of that same dividend-paying stock or of another investment option altogether. This allows you to continuously grow your investments and the number of shares that you own even more than you'd be able to by only contributing your own money. Now, the concept that I just explained is called reinvesting your dividends. We're going to be talking more about reinvesting your dividends for the rest of this video because it's the option that we believe is the most beneficial for the majority of long-term investors. Now, keep in mind that when you're actually approaching retirement, withdrawing your dividends to use as income might be something that you want to consider at that point, depending on what your overall portfolio looks like then. And keep in mind that this would be a part of a broader retirement plan too. But for anyone who still has years for their investments to grow, reinvesting your dividends back into purchasing more shares of your investments can have a very big impact on the growth of your investments.
So why did we say that we feel that reinvesting your dividends is the most beneficial option for most people? The main reason is because reinvesting dividends really allows you to boost your long-term returns because you're able to benefit from compound interest. Every time you're paid out a dividend, you use those dividends to buy more shares, which grows your investment value and increases the value of your next dividend. and the cycle continues. So we're gonna use a really simple high-level example to explain the impact here. So let's say that you invest in a stock that pays a 50-cent dividend annually per share, and that stock price grows by 10% per year. Let's say you invest $20,000 when the stock price is $20, meaning that you were able to purchase 1,000 shares. After 1 year, you'd receive a dividend payment of $500. At this point, so 1 year later, the stock price is $22, and you reinvest your dividend $500, which lets you purchase an extra 22.73 shares. Now let's fast forward to the end of year 2, and you get a dividend payment of $562.50. At this point, so 1 year later, the stock price is $24.20, and you reinvest your dividend payment of $562.50, which lets you purchase an extra 23.24 shares. Now you own a total of 1,045 shares valued at just over $25,000. Now let's fast forward to the end of the year and you get a dividend payment of $627.58. At this point, so 1 year later, the share price is at $26.62 and you reinvest your dividend payment of $627.58, which lets you purchase an extra 23.58 shares. Now you own a total of 1,069 shares valued at $28,471. That means that after 3 years, you went from owning 1,000 shares to 1,069 shares and from a value of $20,000 to $28,000 without adding any of your own money. Now let's fast forward to 20 years later. You'd own 1,401 shares valued at just over $188,000 and your dividend payment would be at just over $2,000. If you had taken your dividend payments in cash instead of reinvesting them, you would have taken out just over $24,000 but still only had 1,000 shares valued at just over $134,000. That's a difference of about $159,000 versus $188,000. So you benefit more by reinvesting your dividends. And keep in mind that this example assumes that you never invested any more of your own money yourself, which of course you will, so the impact would be even bigger. Now we want to mention that dividend investing, which is the term that's used when people purposefully invest in dividend paying stocks, isn't the most optimal way to invest. Investing in only dividend paying companies isn't very diversified. It could actually hold you back because you might not be investing in companies that are seeing the most growth. Remember, dividend paying stocks are usually past their peak growth years. Dividend investing also isn't very tax efficient because dividends are taxable. Unless you're investing in a tax-free investment account, you have to pay taxes on dividends. So ideally, you won't be focused on dividend investing. Now, with that being said, a lot of stocks pay dividends. About 80% of the stocks in the S&P 500 pay dividends. So ideally, and this isn't financial advice, this is just our personal opinion, you won't aim to invest in dividend paying stocks. Instead, you'll aim to invest in passive long-term ETFs, and if those passive long-term ETFs include dividends, then you'll reinvest those dividends that you happen to get. That way, you're purchasing a diversified ETF that allows you to benefit from dividend-paying companies and growth-focused companies. Now, there is a way for you to automatically reinvest your dividends without having to manually repurchase those investments yourself, and that's with a dividend reinvestment plan.
Dividend reinvestment plans, also known as DRIPs, allow you to automatically reinvest your dividends back into the same stock or ETF that paid the dividend out to you. Now, some investment platforms have a dividend reinvestment feature available, and it's great because it means that you don't have to do anything on your own. As long as you're signed up, as soon as the dividend's paid out to you, the platform will automatically put in a new order to purchase more shares for you. Now, these dividend reinvestment features are becoming more and more common for investment platforms to have, which, like I said, is great because it's definitely a very convenient feature to have. Now, traditionally, in order to actually qualify for a DRIP, you'd have to own enough shares of a specific investment so that the dividend you paid out would be larger than the share price. Now, let me explain what I mean by that. Let's say that you own an ETF and you get paid out a $25 dividend, but the current cost of one share of that ETF is $30. That means that you wouldn't be able to reinvest back into that ETF via your dividends because your $25 dividend payment wouldn't even buy you one share of that $30 ETF. Now, the reason that I said that this is traditionally how it works is because some investment platforms now offer something called fractional shares. A fractional trading feature allows you to purchase pieces of shares instead of only full shares. So for example, let's say that you have $100 to invest and you want to purchase an ETF that's currently trading for $30 a share. In theory, that means that you could only purchase 3 shares and you'd have $10 left over just sitting in cash waiting to be invested in the future. But with fractional shares, you could purchase 3.333 shares and have $0 left over instead. So if you use an investment platform that offers fractional shares and a dividend reinvestment feature, then you can qualify for this no matter what. So if we go back to our example from before where you own an ETF and you get a dividend payment of $25, but the cost of one share of that ETF is currently $30, you could reinvest your dividend payment and purchase 0.833 shares of that ETF. Now, this is great because it gets your money invested faster and it also helps grow your investments more, especially over the long term. So in general, reinvesting your dividends can have a big impact on your long-term returns. And if you have a DRIP or if the investment platform you use has a dividend reinvesting feature, then it makes it a lot easier.
All right, so that's a wrap on this video. If you have any questions about dividend reinvesting, make sure you ask away in the comments and make sure you check out this video next. And yeah, we'll see you next week with another video.